Hey, my name is Connor, and welcome to Crypto Empire, where we dominate the crypto markets. This video is purely about risk management when trading cryptocurrency. I will be teaching you how to scale into a position and scale out of a position in a dynamic way, meaning you will be in and out multiple times. So I've developed this method utilizing stop limit orders to scale in and out of trades. This is a must-watch video if you're leverage trading crypto. So if this does interest you, then be sure to stick with me until the very end. Without further ado, let's get right into it and let the gains be with you. Crypto Empire Risk Management, presented by yours truly, Connor from Crypto Empire. So in this video, you will learn how to enter and exit trades like a pro to increase your profit and decrease your losses. Now, before we really get into this video, I do have to say that I am not a financial advisor. This video is for educational purposes only. You need to understand the risks involved with trading cryptocurrency, and if you buy or sell any crypto, you take full responsibility for that. All right, now that that's out of the way, let's get right into this presentation and tutorial on how to scale in and out of your trades in a dynamic way. So, and also, by the way, if you're not already subscribed to Crypto Empire, be sure to hit that subscribe button down below and turn on all bell notifications so you don't miss any future videos. All right, now the lesson plan for today. I'll be going over the type of trader who should be utilizing this strategy or a strategy very similar to this strategy. Next up, risk management rules. When you're trading, it's absolutely imperative to have a strict set of rules that you do follow so you never get emotional and you always stick to the plan. After that, we'll be talking about how to scale in and how to scale out of your trades. We'll be talking about the pros and the cons of this method, and then I'll be giving you some examples in the charts. Okay, now moving on, who should use this strategy? Now, I will say, if you have some trading experience, you'll be able to pick this up relatively quickly, I believe. And if you're new, it might take you a little bit to really comprehend everything that I'm saying right here. But this video will be on my YouTube channel, so you can go and rewatch it whenever you do want. And the timestamps are in the description down below, so you'll be able to skip back and forth if you do so choose to do that. But again, if you have some experience trading in the markets, you're going to be able to pick this up pretty quickly. Anyway, traders must manage their risk at all moments of time. Listen, if you're trading, I put it down here, there should only be three outcomes to a trade: the large win, the small win, or the small loss. If you can eliminate the large loss from your trading, you will be a profitable trader. It's that simple. Just eliminate the large loss. This strategy allows you to eliminate the large loss altogether. So this is absolutely of the utmost importance when you are trading, especially if you're trading with leverage. You eliminate the large loss and you're green. All right, so who is this good for? It's good for impatient, emotional, and impulsive traders. So if you get antsy, if you want to FOMO into green candles, or if you're selling short, you want to jump into a short trade when everything's crashing down with no plan, you just whim it. Or you're the type of trader who, gets too antsy and just feels like they always need to enter into a trade at all moments of time, then this method is for you. Also, as for traders who repeatedly get stopped out, so maybe you're frustrated right now, you keep on taking a trade, you go through your whole entire checklist of a trade, you check the trend, you check support and resistance, supply and demand, all the indicators are lining up, you have confluence, but you just keep on getting stopped out and you don't know what to do next, well then this method is again for you. Also, for traders who sell too early or hold on to trades for too long, this is so common, especially when you're trading with leverage. You sell too early or you hold it for too long and then it turns into a red trade. So me personally, when I was a beginner, I did have this problem of selling too early. I didn't trust myself basically, but over time, you basically develop that muscle to trust your analysis and to trust the trade and let it play out. So this is for you if you do sell too early. This is so common, especially with newer traders. We've all been there. Okay, we've all been there, so understand you're not alone, but you need to fix this right now if you want to become a profitable trader, because you need to let your winners go. You cannot just sell too early and have all of your winning trades if you just held them like the original plan, but you sold them too early so you didn't make even half the amount of profit you would have made. So absolutely crucial if you sell too early or hold on to trades for too long. And really, everyone can benefit from a proper risk management strategy. If you're trading crypto, you need to manage your risk. There's no ifs, ands, or buts about that. Yeah, you could wing it, but that will only work for so long. All right, so that's who this strategy is for. And like I said, there should only be 3 outcomes: a large win, a small win, or a small loss. You eliminate the large loss and you will be a profitable trader. Okay, moving on. So let's talk about scaling into a trade. So this is how to enter a position in a dynamic way. So this is for beginners. Basically, for a beginner, you want to enter into a trade with 10% increments. What does that mean? How do you do that? It's very simple. In the exchange, basically, you just want to set your buy orders of 10% of your trading size, right? So size, you would just put 10%. Very simple. Now I put here, if you're advanced, you can go up to 25% per scale in entry. But for beginners, I would stick with 10% increments. So that's why I put beginner up here. But if you already know what you're doing, feel free to go higher. Okay, so by utilizing only 10% increments, it's in a way like trading spot because you will not have a liquidation price. All right, you didn't put up all of your margin, so you have a lot of room. So hypothetically speaking, if the trade does go against you, let's say you see a picture perfect setup, everything is lining up, the Fibonacci is right there in the demand zone, price is right there, and let's say you take the entry, and hypothetically speaking, let's say there's a black swan event and the market just crashes and we enter into a several multi-year bear market. You can hold on to this leveraged position even though it's leveraged because you took such a small position size. You only put in 10% in the beginning, right? You'll never get liquidated. So it's kind of like trading spot in that sense where you can just hold on, wait for however long it takes. Maybe it takes 1-2 years, hypothetically speaking, before price actually goes back upwards past your entry and then you're in the profit again. You have that flexibility to wait because you are only going in 10% at a time. So it makes it very easy to sleep at night, basically. You don't have any fear of liquidation when you're trading 10% increments like this. So you are allowed, the next rule, you are allowed only one scale in with a position in the red. All right, so a general rule of thumb when you're trading with leverage is to never add to a losing trade. With this method, you are allowed to add one time to a losing trade and one time only. After that, if it keeps on going against you, well, then you get out of the trade altogether, you cut your losses and you get ready for the next opportunity. All right, so you're allowed one scale in only. And typically, like I said, you should never add to a losing trade. This is not dollar cost averaging. Okay, that's different. Dollar cost averaging is an amazing strategy, but we are talking about trading here. This is not investing. There's a very strict difference between the two. Like I always talk about here, Crypto Empire, you have your investment portfolio and then you have your trading portfolio. This is your trading portfolio. The rules are different here. Okay, so one scale in a red trade, and you must use a stop loss if you do add to your losing trade. Okay, so after you basically, let's say you go in 10%, trade goes against you, you go in another 10%. Now you're going to have a liquidation price. All right, so you don't have that ability to hold on forever, even if it just goes down forever. So you need to add a stop loss if you do add to a losing trade, because you never want to risk your whole account with liquidation. That is just foolish to do. Never risk your entire account. Never risk liquidation. Always use a stop loss. Eliminate that outcome altogether by using a stop loss. It's very simple. All right, now the rule, so we scale in on breakouts and pullbacks, okay? So we increase our position size as the trade grows with the trend. So let's say we take our first position when price is down at support, and then price breaks the structure local high, and we see that it breaks the structure to the upside and we're bullish, we're long. So then we go in another 10. And then from there, price keeps on pumping up, but then it reverses and it comes back and it tests that previous breakout line. So that's a pullback. So then we put in another 10%. Okay, you see where I'm going with this? And then price breaks out, and from that previous local high it made, it breaks out, it makes a higher high. When we see that breakout, we go in another 10. Or if you want to go heavier, if you're more advanced, you can go 25% at a time. But right now I'm talking to beginners for the most part. So you scale in on breakouts and pullbacks. I'll be hopping into the charts with the examples later on in the video, but that's the basics of it. It's very simple for the most part. Once you understand how to do this, it's going to make your trading so much easier. All right, so that's scaling into a trade. Now let's talk about the pros and the cons of scaling into a trade with this method. Okay, so the pros, to scaling in, one, you're able to capture the entire trend. All right, by constantly getting in when it makes a new high and then it pulls back, break out again, you put in another 10%, you're able to ride out the meat of a trend. And for swing trading, this is how it's done. This is how the big bucks are made. You trade with the trend, you ride out the entire trend, and then when the trend reverses, you switch your bias. Very simple. So that is definitely a huge pro of this method. Another one, there's no risk of your position getting liquidated. Like we said, even if you just go in 10% and then it goes all the way to zero, you wouldn't get liquidated, okay? But again, if you do scale into a losing trade, meaning that one option you have of when your trade goes red, you can scale in once only, well, then you use a stop loss and you still don't have any risk of liquidation. Okay, so like I said, wider stop losses. With only using 10% position sizes, you can have wider stops and still risk small amounts. So with only using 10% increments, basically, it's not like you're going in with 100% of your account and you need to have a very thin, 5% stop loss, which is usually the customary for leverage trading. You're able to have a much wider stop loss. You can place it beneath a much lower demand zone or support level because you have that flexibility of no liquidation price by going in with only 10% increments. Next pro would be smaller losses. So if you do add on a red trade and it ends up getting stopped out, it will not be a big loss because it's only 10 to 20% of your overall account size. All right, so you eliminate that big loss outcome from your trading, which, like I said, makes it very easy to be profitable. You can still be wrong over half the time. Like, your win percentage doesn't really mean anything. That's the next point. More opportunities to be successful. You can be profitable even with a small win percentage. You can lose 5 out of 10 times on your trades, but your winners are always going to cover your losers because you were managing your risk and position size with this method. And then the next one, you don't need to be a market sniper to be profitable. You don't need to catch the exact bottom of a move to the tick and then watch it go up from there. You don't need to be a market wizard or market sniper with this method because it allows you to be so flexible because of how you enter into the trade dynamically with only 10%. And you have very low liquidation prices and you always have your stop losses. You don't need to be a market sniper. So this makes it easy for anybody to be a profitable trader. The cons to the scaling method, more trading fees because you're opening more positions for each trade, and this is a pretty negligible con. Whatever, your wins are going to cover the trading fees regardless, but nonetheless, some people might not be a fan of that. And then after that, make less profit on a perfect sniper entry. So you're only going in 10%, or if you want 25%. So it's not like you're going in with 100% if you catch an exact bottom of something and watch it go up. So you're not going to be able to basically catch the entire move with your entire position, which means a little less profit overall because by scaling in, your average price will be higher, but it's really not that big of a deal because you're still going to be profitable and there's nothing to complain about if you're pulling money out of the market because the market is ever providing. And once you learn how to do this, you will be able to tap into that never-ending flow. All right, so that's scaling into a trade, the pros and cons. Now let's go ahead and talk about scaling out of a trade. Okay, and this is really the most important part. Once you're in the trade, you need to know how to manage the position. And this is all about managing the trade once you're inside. This is, without a doubt, one of the most important parts of trading with leverage, managing the open trade. It's a lot of times traders will get a good entry, but they don't know how to manage the position and they'll still squander the opportunity. So I can't stress it enough. Know how to manage the trade, know how to scale out, all right? And we utilize the stop limit order ladder method for that, all right? So multiple stop limit orders are used for each trade. And this allows you to exit with profit with every order that gets hit. So we ladder the orders. I'm going to be getting into an example in just a little bit, but let's say you enter into a trade at $1 and then it pumps up to $2. Basically, you ladder your stop limit orders downwards. So you have one at $1.80, one at $1.70, one at $1.60, one at $1.50. So let's say price does come back down towards your entry at $1. You get stopped out, but it's all in the profit. So you're laddered out. So it's very helpful for that. So now the next part of this method is you scale out of the position 20% at a time. All right. So this is the opposite of scaling in. When you're scaling in, you go 10% at a time. when you're scaling out as a beginner, you want to take out 20% of your position at a time, which basically means you're going to have 5 stop limit orders as your stop loss. All right, 5 stop limit orders, 20% of your position at a time. Obviously 20 times 5 equals 100% of your position. All right, if you're more advanced, you can scale out 10% at a time, but just know that means you're going to have to be managing 10 stop limit orders, which is why I say if you're a beginner, well then use 20% at a time. Okay, so this requires more trade management to have 10 stop limit orders instead of 5 like I just said. So I don't recommend having more than 3 open positions when you're trading with leverage at a time, especially if you're new. All right, because especially with managing your trade, you're going to be setting up a lot of stop limit orders. And if you're brand new to doing this, it's going to take a while for you to really get proficient at it. You will get better over time. Repetition is the mother of skill. So the more you do it, the more reps you have of setting up your stop limit ladders, the better you're going to get at it, the quicker you're going to be able to do it. But when you're just starting out, just stick with 1 trade at a time, master this method, and then go to 2 trades and then 3 that you have open at a time. And you're going to see how well this method does work when you try it out on your own. All right, so you tend to your stop limit orders really every day. You should be resetting your stop limit ladder every single day. But you can do 1 to 3 days, because let's say that the market just goes sideways for 2 days straight, so you don't have to adjust your ladders. That's fine. All right, on the 3rd day, just adjust it, because I guarantee you the market will move in some way. Maybe one of them will get hit. So 1 to 3 days, but realistically you need to be on top of your stop limit ladders, managing your trade every single day. All right, and just like when you're scaling in, you scale in on breakouts and pullbacks. When you are scaling out, you scale out on breakdowns of support levels and on level retests, right? So let's say you break out and then you retest the breakout level, then you can scale out there. You can have a ladder stop limit order placed there. So that is the basis of the method. I hope it makes sense. Like I said, if you're brand new, you might have to watch this one more time to really understand what I'm saying. But if you've traded before, if you have experience, you should be able to pick this up. All right, now before we get into the examples, let's talk about the pros and cons of this scaling out method. So the pros to the scaling out method is you can ride out the entire trend. All right, market's trending upwards, pulls back, your ladders get hit, and then you start to re-enter again with the scaling in method. So when it starts to break out again, you enter back into the position with the trend. On the next breakout, you enter in another 10%, etc., etc. Pull back another 10%, and then you set your ladders. So you're in and out. This is very dynamic. This is not sitting stagnant on your hands. This is you being very active, watching your trade as it does develop, and this does allow you to ride out the entire trend. So parts of your position will be stopped out along the way in a profit as your trade moves upwards, which is great. So you take profits as your trade moves in the correct direction with your stop limit ladder orders. So then you can refinance the average price of the trade. What do I mean by refinance the average price of the trade? So if your first stop limit order gets hit and keeps going down, you can wait for the price to form a technical bottom signal like a double bottom, W reversal, inverse head and shoulders, etc. And then you can go ahead and scale back into the position at a cheaper price, meaning you basically refinanced your trade, right? You got it at a lower price, and you already took some profit because you had your stop limit ladder set up. So you can get a lower average price with this method as you ride out the overall market trend. After that, there's zero fear of liquidation, of getting stopped out for a big loss, again, because you're protecting yourself. You are setting your stop loss orders in the profit, your stop limit ladder orders, they're all going to be in the profit for the most part, maybe at a slight loss if you do enter into a red trade one time, but nonetheless, you don't have to worry about getting liquidated. You can sleep very well at night, and you're eliminating that large loss scenario from your trading, which will make you a profitable trader, right? If you utilize this method, all you need to do is eliminate that large loss. All right, after that, no winning trade will turn into a loser. All right, so you never want to have a green trade turn red. That's the worst thing you can do as a trader, is have a position that's heavily in the profit. You don't manage the trade correctly. You never move your stop loss up. You don't set up any ladders. And then your big winning trade turns into a losing trade. Never have that happen. And if you follow this method, well then guess what? You eliminate that scenario from happening as well. So that's amazing. So the cons to the scaling out method: more trading fees again, because you're going to be placing multiple stop limit orders. It's a pretty negligible con. Your wins will cover all of the trading fees and much, much more. So not a big deal, but again, for some, they might not like that. And then the next con would be you won't sell your trade at the exact top. So a lot of people want that satisfaction of selling at the exact tick before price reverses. This method with your ladders, you're not going to be selling the exact top. So some may see that as a con, some may see that as a benefit, but nonetheless, you can't sell the exact top when you're using a stop limit ladder to scale out of a trade to manage your risk. All right, so these are the pros and the cons of scaling in and out of trades with this method. Now let's get into a hypothetical example, and then we'll hop into the charts and give an example in the charts. All right, so let's say you were trading in $5,000 increments. All right, so you have $5,000 for a trade, and you see a picture perfect trade set up on coin XYZ, right? Hypothetical example. So let's say you're looking at a coin and it's sitting in a beautiful picture perfect drop base rally demand zone, and the golden pocket, the 61.8 Fibonacci, lines up perfectly, also sitting on trendline support. It's just like a perfect trade setup. Your eyes are popping out of the screen and you want to get into this trade. All right, so basically the coin XYZ is currently trading at $10, sitting at this picture perfect entry. So you enter into this position. For this example, we're going 25% increments on entry because the math is just much more simple. So coin price is currently $10, coin XYZ. So you enter your first 25% of your position with $1,250. Okay? And then from there, some market news comes out and price drops from $10 to $7.50. So because you were allowed one scale in on a red losing trade, you go ahead and you decide to scale in another 25% when price is at $7.50. So you put in $1,250 again. All right, so now you are in 50% of your overall position size with price at $7.50. And then all of a sudden, price pulls a 2x, right? It goes up to $15. So at $15, that's a breakout. Remember, we scale in on breakouts and on pullbacks. So on this breakout, you decide to scale in another 25% at $12.50. And then from there, we have a pullback to retest a previous level. And remember, we can scale in on pullbacks. So with this pullback, price goes to $12.50. So we put in our last $1,250 into the trade. So we now have all $5,000 in the position, and our average entry price is $11.25, right? If we add up $10, $7.50, $15, $12.50, add those up, divide them by 4, the average comes out to $11.25. All right, that's very important to have your average price. You always need to know your average price. If you're trading spot, trading with leverage, it's just one of those metrics that you need to keep account of if you're not already doing that. So you now have all $5,000 in the trade. So from this point onwards, you have three options. Option number one is you can place your stop loss at break even to feel safe. So let's say you don't feel like utilizing the stop limit ladder method. You just want to put your stop loss at break even and just let it do its thing. So our average entry price is $11.25. So we put the stop loss order just above our average price. So we cover the trading fees and we can get stopped out and it's no loss to us. And if it goes in the direction we want, it's a free trade. We get a profitable trade and we're happy. All right. So that's option number one if you choose to do that. Option number two, again, if you don't feel like scaling out, is you would put your stop loss at a 10% profit. All right. So let's say you don't feel like putting in the stop limit ladder. You're feeling lazy that day or whatever. You don't want to put in the work of just setting up your orders. It's so simple to do. So there's really no excuse, but nonetheless, you don't feel like scaling out that day. So you put your stop loss at $12 and you say, if price comes back down to $12, I'll take my 10% profit and I'll just wait for the next opportunity to get back into the market with this trade. That's fine. That's option number two if you choose to do that. Now, option number three is obviously the option that I do recommend you learn and you master and you become very proficient at because it will take your trading to the next level, is to stop limit, scale out, ladder your exit. All right. So for setting up the ladder, we're going to use 25-cent ladders and we're going to scale out 20% at a time. So how I did get 25%, this is very important. It's very simple. The current price is $12.50, right? That's the last price we purchased at, and that's where price currently is, $12.50. And the average price is $11.25. So we subtract $12.50 from $11.25, and we get $1.25. Because we're going to scale out 20% at a time, we divide that by 5, right? So $1.25 divided by 5. I'll show you right here. 125 divided by 5, that's 25 cents. Okay? So that's how we scale out 20% at a time, and that's how we know what size to do that. All right? So it's very simple how we would do that basically. You just come to the exchange. You want to make sure you're on stop limit. And then you would drag your slider to 20%. And so stop price, this is your trigger price, right? If you don't know about order types, watch my full trading course tutorial. I go into the order types in detail there. But nonetheless, your trigger price, $12.50 is the current price. So you would put your first order at $12.50 or $12.25, I mean. So your trigger price would be $12.30. And then you would want the order executed at $12.25, right? So you always want to put your trigger slightly above the actual order price that you want the order to be executed. And then from there, you would go $12 with a trigger price at, $12.05 for your second ladder. And then your third ladder would be $11.75. From here, all you do is hit sell short, and the order gets placed. Very simple. And you're on good till cancel as well. All right. And of course, reduce only. You want to make sure reduce only is checked off as well. That just means you won't be adding to a position. You won't be setting up a short. You'll just be reducing your current long position. So always make sure reduce only is checked off. And then 11.75, so you would put 11.80. And then 11.50, so on and so forth, 11.55. I think you get the point by now. That's how you basically go about doing it. Not too complicated. If you have any questions, definitely ask them in the comment section down below. Nonetheless, that's how you set up the stop limit order. Hope that makes sense. Again, any questions, ask them in the comment section or join the free Telegram group. Now let's talk about an actual kind of trade example. So Cosmos Atom, one of my favorite altcoins, we've caught in the premium Discord group, we've caught every single Atom pump over the last few months, right? We've been making a killing with Atom. Nonetheless, let's go over this example. So for this example on Cosmos Atom, looking at the chart, came off a beautiful rounding bottom over the summer during that 3-month bear market consolidation we had. And then we start breaking structure highs. We start printing new highs, higher lows. The market is clearly forming an uptrend. So we say Atom looks great. And then from here, we can see that we have this horizontal resistance level at $26. And then we had one touch, right? Then we got rejected. We had a second touch. And we see this clear ascending price action. We know we're uptrending. So this looks great. This is a beautiful ascending triangle. We say we're going to take this trade and we're going to start to scale in when it breaks this horizontal resistance. So what we go ahead and do is we see price break out, make a higher high here. So we put in our first scale in order at 10% of our position, or if you're more advanced, you'll go in 25%. But again, I'll stick with beginners here. So on this breakout, when price makes a higher high, you go in with your first 10%. And then from there, it turned out to be a false breakout. Price got slammed down right back to the previous support down here at $21, $20. Because the rule, remember the rule here, we are allowed only one scale in with a position in the red. So our position is now in the red, but we're still bullish. We see prices forming a bottom. Price action looks good. So we then go ahead and decide that we're going to enter into our position with another 10% of our capital. All right, so this is our second entry down here on the pullback in the red. We now put our stop loss in place. We start to ladder because remember, the second we enter into a position in the red, we now have a liquidation price. We never want to get liquidated. This keeps on going down. So we put our stop limit ladders in place from this point onwards. From now, price starts to move upwards again, and we break out of the previous structure high. Remember, we enter, we scale in, on breakouts and pullbacks. All right. So this first one was a breakout. Then the second one down here was a pullback. And now the third 10% entry scale in is another breakout, the new high. Okay, so we put another 10% and price is moving up. So we move our ladders up as well. So we're protected if price goes against us, right? Let's say it goes against us here. We get our first ladder hit. That's all good. We still have our lower one set. And we basically just ride it out. We adjust the orders. And then price starts to move upwards again. All right, so we make a new all-time high on Atom back in early September at $39. And then we pull back. And we pull back right into a demand zone down here. All right, so this would be our fourth scale in on a pullback. From here, price starts to, first it tests the local structure high, pulls back to support, and then it goes ahead and it breaks out of this previous all-time high. So we scale in another 10%, okay? During this entire time, obviously, we're moving our ladders upwards as well. And then from here, what happens is price goes in and makes an all-time high at $44, but then it gets slammed down all the way back down here to this demand zone at $29. But because we had our ladders in place, when it did slam down like this, our stop limit orders get hit. So it's fill, ding, 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 cash out, money in our account. This entire time, our orders are getting hit. Our stop limit, stop loss orders are getting hit on the way down. But our entry, our average price is so low, we're just winning, okay? And then price comes back down to the demand zone down here. And then we see it start to form a reversal. So then when it starts to break out again, we take our next entry, right? We start to scale in again, 10%, right? Another 10% on the next pullback, so on and so forth. So this is really all this method is. It's very simple once you actually understand it. It's not too hard to do. Remember, repetition is the mother of skill. So start out doing this at one trade at a time, then work your way up from there. I don't really recommend more than 3 open positions at a time with leverage. But if you can manage more, well then so be it. Go ahead and open up all the positions that you do want. Just make sure you always exercise proper risk management. Again, repetition is the mother of skill. Start to practice this. Once you get it down, it's going to take your trading to a whole nother level. You eliminate the large loss outcome. You make taking profit extremely easy when you are trading. It takes all emotions out of it. You're going to be able to sleep better at night. And of course, you will increase your profitability. And like I said earlier in the video, you don't even need a high win rate. You can be wrong a lot and still be profitable because you were always managing your risk and eliminating that large loss scenario from your trading. This video showed you how to manage your risk and position sizing when you're leverage trading cryptocurrency. I hope you enjoyed the video. If you did, make sure you let me know by leaving a like down below. Any questions or you just want to say anything, leave a comment down below. And also, if you're not already subscribed to Crypto Empire, definitely be sure to hit that subscribe button and turn on all bell notifications so you don't miss any future videos. Also, be sure to join the Crypto Empire free Telegram group. Link is down in the description below. Happy trading. Use this method, increase your profitability, and decrease your stress levels. Hope you enjoyed this one. I'll see you in the next video.